Well, thanks so much to everyone for coming to hear about my research. So the starting point of this paper is the question of what happens when a government defaults on its debt. So you may be familiar with this question, its importance from a few recent episodes. So in particular, a few years ago during the European debt crisis, there was this big question of what exactly would happen if Greece defaults. And that's related to the question of how hard should Greece try to repay its debt. And so I picked an article from CBS that basically said that all creditors and all participants in the Greek financial drama agreed that essentially default is something that ought to be avoided at all costs. So there's this sense that it's this impending and very negative effect if a country actually defaults on its sovereign debt. In the US, we see this question of how bad is it if the government defaults on its debt in the discussion around the debt ceiling. So the idea that if the Treasury doesn't, if Congress doesn't raise the Treasury's ability to borrow, the US won't be able to continue servicing its debt, and essentially something bad will happen. So you see this in the New York Times, the idea that if the US defaulted, it will cost the Treasury tens of billions of dollars every year for decades to come in the form of higher interest rate charges and probably trigger a severe recession. And so in the media, you see this idea that default is very, very costly, but I think there's a deeper question of why, and also how would we ever know that? And so the idea in this paper is that what we need to do to measure the costs of sovereign default is to separate the idea of whether a government is actually defaulting because the economy is getting worse, or if the economy is getting worse because a government defaults. When you actually see a government defaulting in the real world, you're always seeing them kind of stopping paying their debts in the worst part of a financial crisis, because they find that the money is particularly important, and so they stop servicing their debt to creditors. So how would we ever actually separate cause and effect when what usually drives countries to actually repudiate their debts is this very negative effect? In economics and finance, what you're usually looking for in order to ascribe a causal effect is some sort of randomization. You want some random shock so that you can evaluate those that were treated against those that were not treated, treatment and control. But of course, in reality, countries never actually default randomly. The starting point of this paper is to come essentially as close to that thought experiment as we can and look at the one instance in history where we can say the decision to default was caused by these outside forces, or quasi-random variation. And so that's going to lead me to look at this recent Argentine default in 2014, where what you have is a series of legal rulings in US courts that essentially raise the probability that Argentina defaults, and therefore we can look at how the market prices these increases in the probability of Argentina's default to look at what the market participant thinks will be the cost of default. So this is based on a paper with Ben Hebert at Stanford called The Cost of Sovereign Default, Evidence from Argentina. So for those of you that aren't familiar with the recent Argentine history, let me give you a little bit of background. So Argentina defaulted on $100 billion of debt in 2001. This was at the time the biggest sovereign default in history. And it happened in the middle of a major financial crisis. In 2005 and 2010, Argentina restructured 93% of its sovereign debt. What that means is they went to creditors who owned these defaulted bonds from 2001, and they made them a take it or leave it offer. We're going to give you new bonds that are worth 30 cents in the dollar, but we're going to start paying them. And so if you surrender your claim against us, we're going to start paying you on these new bonds. There were 7% of creditors, led by Elliott Capital, that did not take the deal. And what they did is they sued in US courts under the premise of the so-called pari passu clause in the sovereign debt contract. Pari passu means that Argentina promised its creditors equal treatment. And what the holdout said is that by paying the restructured creditors but not paying the defaulted bonds, you're violating the bond covenant. And so what creditors did is they tried to prevent financial intermediaries from facilitating payments to the new creditors to force Argentina into default. So what this means is that when Argentina makes a bond payment, it doesn't track down all the individual holders of its bonds. It sends $500 million to Bank of New York Mellon, and through the magic of the financial system, Bank of New York Mellon makes sure that everybody gets paid. And what these legal rulings were doing was essentially making it illegal for whether or not it would be illegal for Bank of New York Mellon to facilitate payments to the bondholders, and so therefore whether or not Argentina would actually make its bond payments. And so what we have from February 2012 to July 2014, we have a series of legal rulings starting in U.S. District Court, going up to the Appeals Court, all the way up to the Supreme Court, back down and then up again, about whether or not Argentina is going to be allowed to continue to pay its restructured creditors. And the idea of the paper is that each of these rulings is going to essentially be a random shock to the probability that Argentina defaults. This eventually ends with the Supreme Court refusing to review the lower court's rulings, saying that Argentina cannot pay the restructured creditors without paying the holdouts, and Argentina actually ending up in a default on its sovereign debt. So this may be familiar to you, and in particular, one part of this episode is kind of the most famous, that Argentina actually managed, the creditors actually managed to seize an Argentine naval vessel in Ghana because Argentina was, violating these U.S. court rulings. I'm actually not going to be using this ruling, but this is kind of the most famous part of the episode. Instead, the first thing I want to show you is what happens on the day that the Supreme Court refuses to review the lower court's ruling and actually essentially makes the ruling that Argentina cannot repay permanent. So what's nice about looking at rulings of the U.S. Supreme Court is you can be very confident that information did not leak out ahead of time. And in fact, we can say to the minute when it became public information that the Supreme Court was not going to review the ruling that Argentina had to repay the holdout creditors if it wanted to pay the restructured creditors. Using credit derivatives called credit default swaps, and I'm happy to talk more about this, at 9:30 a.m., there was a market implied probability that Argentina would default over the next 5 years of 66%. The ruling occurs at 9:33 a.m. Over the next hour, the probability that Argentina defaults, as measured by the London close times, the probability that Argentina defaults goes up 10 percentage points, up to 76%. During that same time, the value of the Argentine equity market falls by 6%. And so this is a case where you can say, we know the shock originates from the probability that Argentina will default. It's the Supreme Court ruling. And so that 10% increase in the probability of default caused a 6% fall in the stock market. Now, we don't only have that one particular event. In fact, there are a number of legal rulings, 15 of them, that we can look at. So let me explain what this chart is to you. On the x-axis, over every 2-day window between 2012 and 2014, we plot the market implied change in the probability that Argentina defaults. On the y-axis, we have the return on the Argentine stock market. The whole key is in gray, if you can see these dots here, these are just all days where there's no legal ruling. And so you see a strong negative relationship between probability of default and the return on the stock market. But you don't know what causes what there. If the VIX goes up or there's bad news for Argentina's GDP, that could cause the stock market to fall and the probability of default to increase. The key idea is that on these 15 days, we know that what's happening is that US courts are making a legal ruling, and that's driving the probability of default. And so in this set of events, we have the Supreme Court denial that I already mentioned. This is a huge increase in the probability of default and a big fall in the stock market. But we don't only have these negative shocks to Argentina. Here we have on November 29th, 2012, and actually a 10% fall in the probability of default and a huge rally in the Argentine stock market. What happened there was unexpectedly the U.S. Appeals Court put an emergency stay on the district court's ruling, essentially putting on hold the idea that Argentina was going to be forced to default on its debt to the restructured creditors. And so what we do in the paper is we do something called identification through heteroscedasticity. For the purposes of this talk, I'm going to look at it like an event study, which means that we estimate the causal effect by fitting a line through those 15 days in red, where we know what the source of variation in changes in the probability of default are. What's the estimate of the causal effect of sovereign default in this paper? It's the slope of that red line. How a 10% increase in the probability of what the effect of a 10% probability increase in the probability of default has on the value of Argentine equities. And so it's actually exactly what we see on the day of the Supreme Court. A 10% increase in default probability causes a 6% drop in the market. Now, you can see the value of actually looking at this kind of natural experiment for understanding the causal effect of sovereign default by essentially looking at a placebo test. Here on the x-axis, I have the exact same change in the probability of default in Argentina, but now on the y-axis, I have the change in the Mexican equity index. If you look at all the days where Mexico, there's no ruling for or against Argentina, you have this strong negative correlation between Argentine default probability and Mexican equity returns. And that's because things like the VIX going up are going to look like they're driving both. On days where you actually know what's causing the change in the probability of Argentina's, the likelihood that Argentina defaults, there's no relationship at all between the two. So now why would this default be costly when all that happened was, a US court made a ruling against Argentina and the letter of the bond covenant was broken? To be clear, Argentina actually did send its last bond payment to creditors, and it simply wasn't forwarded on to bondholders because Bank of New York Mellon abided by the court ruling. So why was this costly? So the first thing to do, when you're an academic researcher looking at this stuff, is seeing if people who are actually in the market know what's happening. So here, it's just a summary of what S&P actually thinks happened. And so if you look at this, what they say the day after the downgrade is that after the Supreme Court ruling, they downgraded Argentina and say the downgrade of Argentina largely reflects the US Supreme Court decision, not deterioration in other credit factors such as macroeconomic trends. Nevertheless, we expect a sovereign's potential default or exchange to hurt investor confidence and impact macroeconomic data. They say something very similar on August 29th after the default. But the key is, what you'll see, and you see this across reading the views of market participants, they know that this is going to be bad for Argentina, but basically they just kind of say, it's going to generally hurt macroeconomic trends. So this is actually where turning to kind of economic theories can help you. And so what we do in the final part of the paper is try to lean on kind of the academic explanations for why a default would be costly and test them using market data. So the idea here is, throughout the academic literature on sovereign debt, people try to explain why it would hurt a country if they default. And so here are the kind of prominent explanations. So first, one would be that once a country has defaulted, it's an international pariah. It now becomes less costly for the government to do other things that hurt investors, such as expropriate foreign investors. So to test that, what we do is we form a portfolio that goes long the subsidiaries of foreign firms in Argentina and short all other firms. Another theory would be that it goes through the banking sector, that banks own these sovereign bonds, and if the government defaults, it's going to reduce the value of banks. To test that, we go long banks, short non-banks. Another theory is that if a government defaults, the economy is going to be hurt because exporters are hurt. Once a government's in default, creditors are going to try to interfere with your trade. We go long exporters, short non-exporters. Another theory would be that it would hurt the importers, and that's because in order to actually produce a good in Argentina, if you use intermediate imported goods, you would actually have to get some credit. If you were going to use a machine from the US, you'd have to borrow in order to finance your import of a machine. If your government's in default and you can't do this, you're going to have to switch to less efficient domestic alternatives. And so what we do is we form portfolios based on this idea, and we simply say, okay, to everyone actually trading these individual equities who presumably have a much better idea of what the effect of the shock would be on each individual firm that they cover, how differentially harmful is it if the probability of default increases? And so what we see is we basically correct here for the abnormal return on a portfolio just from its differential loading on the local market beta. That's on the x-axis. And on the y-axis, it's how much the value of that firm actually fell in response to an increase in the probability of default. And so what we see is indeed the academic theories do have some explanatory theory as reflected in the behavior of people trading in these markets. Exporters saw their returns disproportionately fall following an increase in the probability of default. Foreign-owned firms disproportionately fell, as did financial sector firms. So this is pointing for direct evidence that these sectors in the economy were adversely harmed by increases in the probability of default. And so with that, I think I do want to come back to this idea that the deeper academic interest in this question tends to be a little bit different than the way practitioners look at it. There's this deep question in international finance of why would a government ever repay its debt if there's only limited things that a creditor can do to punish it? We think that students repay their student loans because if you don't, you get your wages garnished. Countries don't usually get invaded by this, yet they don't usually get invaded if they default, but they tend to repay anyway. So the contribution of this paper is to say, well, one explanation is that the cost to domestic firms from your government defaulting is actually so big that, even though your creditors can't directly invade your country and seize your assets, you still might have this large effect. And so we've presented some evidence through the channels through which this may be costly. So thanks very much.